Hey, Kim, we just saw the last day of the quarter and the first half of this new year. As you know, all three major US stock market indexes rose, setting new closing records. Also, it's the fifth straight month of gains, up 14.4% for the first half of this year. I feel like we can talk about the stock market all day. But with all of this news about stocks and S&P, I want to know, is this when we should be taking a step back and think about rebalancing our portfolio?
That's a great question. Whenever you see the market kind of take these bounds and leaps as far as the stride's concerned, when it goes up so fast, it's a great time to be looking at rebalancing because things can just get way out of whack. Now, what that's going to look like is different for everyone. Everyone has kind of their own different asset allocation and how they've structured their overall portfolio. But especially when you see the stock market just flying like it has, it can be a good time to reevaluate things and see if it's a good time to rebalance.
And Kim, you brought up this graph here of a well-diversified portfolio. So this is stocks are some component, but we shouldn't necessarily go 100% all in on stocks.
Right. Especially like for a lot of my clientels, I work with a lot of the retirees and kind of pre-retirees. Being 100% in the stock market just simply wouldn't be appropriate anymore. So a lot of times we have mixed in some safer asset classes, bonds, safe investments, things of that nature. So when you see that equity portion, which is the highest risk, really take off, then it can make kind of your portfolio out of whack, which can make sense to kind of do what we call sweeping of gains, moving some of the assets out of the equities and then back into those safer, lower risk investments.
All right, and you're speaking of assets, Kim, so let's talk about it. Asset classes, year-to-date total return. We've always been talking about oil for a bit now. As you know, it was up to $75 a barrel. Those are prices we haven't seen until 2018. Then there's commodities, Bitcoin, stocks again. So when you look at this graph, Kim, what sticks out to you here?
Well, I mean, I think you said it. Oil has just flown lately, and that, has been a surprise. I guess not a surprise and not a surprise, but certainly how fast it's flown to increase. So especially, if you've got a specific holding in any one sector, you want to make sure to really keep a good pulse on how these different sectors are performing. So if you've got an oil part of your portfolio and it's gone up that much, it's definitely time to, again, kind of reallocate, bring that back down where it's not so wide of a mix of your overall portfolio.
Yeah, rebalance, you said those percentages. And for somebody at home who's watching this and doesn't understand, what does 60-40 versus 70-30 actually mean?
So 60-40 is what we see a lot of times, a typical retiree portfolio consisting of 60% being equities. And within that equity mix, you could have, large corporations represented, mid-sized companies, small-sized companies, international. And then the 40% tends to be either safe money instruments or a lot of times bonds. So especially over the past several years, let's say that a retiree started 60-40. Now looking at their portfolio, because equities have done so well, they might be closer to 70-30, which a lot of times kind of defies their even comfort level as far as risk is concerned, and they don't even know it. So it's really important to at least take a look at that once a year and make sure that you're still, balanced overall.
Yeah, that makes a lot of sense. And I know that, we can get in the weeds here, Kim, and there are a lot of tax consequences. It's complicated. If somebody has some questions and would like you to walk through their portfolio and whether their money is working for them, how do they get a hold of you?
That's a great question. The easiest way to check us out and just get a hold of us is going to our website. You can see it on the screen there. It has all the different ways they can contact us, whether it be phone, email, and we'd be happy to set up either a full-blown consultation or just a 15-minute chat to see, is that the next best step, or to answer some direct questions.
Perfect. So easy. All right, Kim, thank you very much.
Yeah, thank you. Great talking to you.